Welcome to the deep dive. Today we're looking at, well, the company defining so much right now, NVIDIA. Our source is their official Form 10Q for the second quarter of fiscal 26. That period ended late July 2025.
Right. In this document, it's really something. Our goal here isn't just headlines. We want to really get into what's driving this, unbelievable growth.
Yeah.
But just as important, understand the risks. There are serious geopolitical factors, product transitions, things causing real bumps in the numbers, even amidst the boom.
It's kind of a paradox, isn't it? Massive success meeting massive uncertainty.
That's a good way to put it. A study in extremes.
Okay, let's start with the scale because the numbers are just, well, jaw-dropping. Q2 fiscal 26 revenue, nearly $47 billion.
$46.743 billion. Yeah, I mean, think about that. That's up 56% from the same quarter last year.
56% year-over-year growth on that kind of base is just wild.
And it flows through. Net income hit $26.4 billion. That's up 59% year over year. And if you zoom out, look at the first half of their fiscal year. Total revenue is over $90 billion, $90.8 billion.
Over $90 billion in 6 months?
Uh-huh. That's a 62% jump compared to the first half of last year.
Well,
It feels like they're just vacuuming up the world's AI spending right now.
so where is this fire hose of money actually coming from? Let's break down the segments. The big one is compute and networking, CNN.
Yeah, CNN is the story. In Q2, it pulled in $41.3 billion.
Just CNN alone.
Just CNN. That's also up 56% year over year. Graphics, their traditional business, still growing, $5.4 billion, up 51%, which is great.
Still impressive growth for graphics, yeah.
But it's dwarfed now. NVIDIA, functionally, it's a data center company. Gaming is almost a side gig.
Okay, drilling into that data center number, the DC revenue, $41 billion and change.
$41.096 billion, yeah, and most of that is DC compute, the actual chips, $33.8 billion.
Okay, $33.8 billion, up 50% year over year. But the report notes something interesting there. Sequential dip.
Yes, a slight one, down 1% from Q1. And they explain why.
Okay. What's the reason?
It was driven specifically by a $4 billion drop in H20 sales. That's their chip tailored for the China market under previous restrictions.
$4 billion. That really quantifies the impact of those U.S.-China tech tensions, doesn't it?
Immediately. It's a direct line item reflecting geopolitical shifts. We'll definitely circle back to that H20 situation. But setting that aside, the other part of data center is just exploding.
The networking side.
Exactly. DC networking revenue, $7.25 billion in the quarter. That's almost double year over year, up 98%.
98%. So it's not just about selling the processors anymore.
Not at all. This proves they're selling systems. Integrated full-stack solutions. That networking growth comes from things like NVLink, their high-speed interconnect for the new GB200, GB300 systems, and InfiniBand, too.
So they're basically saying, you want our best AI performance, you need our chips and our networking fabric.
Pretty much. They're selling the whole package, the whole rack, high-speed connections between everything.
That makes sense from their perspective. Get the wholesale, lock people in.
Right.
But you mentioned the new systems, the GB2 and 300s. That's the Blackwell transition, right?
Right. The shift to the new Blackwell architecture is well underway. The 10Q confirms the Blackwell revenue ramp continued in Q2.
Any specifics on that ramp?
Yeah, they specifically mentioned Blackwell Ultra platforms, like the big GB300 systems, actually started shipping production units in Q2.
So real customer deployments are happening.
Seems so. And Blackwell revenue grew 17% just from Q1 to Q2. They move fast. Controlling the whole stack helps that. It makes it harder for customers to mix and match.
But that speed and scale, it must create dependence on their biggest buyers. Does the report mention customer concentration?
Oh, it does. Big time. Huge risk highlighted right there. In Q2, just 2 customers, called Customer A and Customer B.
Anonymous, of course.
Of course. They accounted for a combined 39% of total revenue.
39% from 2 customers.
Yep. Customer A was 23%. Customer B was 16%. Mostly as you'd expect in that compute and networking segment.
Wow. So if one of those big cloud providers, presumably, taps the brakes on spending.
Exactly. Or, makes progress on their own custom AI chips, that 39% figure becomes a major vulnerability, a potential shockwave. It's a huge strategic balancing act for them.
That concentration and the shift to selling whole systems leads us right into margins, doesn't it?
Yeah.
Q2 gross margin was 72.4%. Still amazing, but down a bit.
Down from 75.1% last year, yeah. And we need to unpack the why carefully here. There are kind of 2 main things going on.
Okay. What's the primary driver?
The main reason for the percentage dip is actually operational. It's that shift to Blackwell systems we just talked about.
How does that lower the margin percentage?
Well, selling a whole integrated data center system, a full rack with networking and everything, it just has a naturally lower gross margin percentage than selling, say, just the high-end Hopper HGX chip modules like they were doing more heavily last year.
Right. More components, more pass-through costs, and a bigger system bundle, even if the dollar profit is huge. Makes sense.
Exactly. So that's factor one, lower margin profile on the newer, bigger systems.
Okay, what's factor two? This sounds like where the geopolitics comes back in.
It does, and dramatically. This is about that H20 inventory. Remember the $4 billion drop in H20 sales in Q2?
Yeah.
Well, because of the U.S. government license requirements that kicked in back in April 2025, NVIDIA had to take a massive $4.5 billion charge in Q1.
A $4.5 billion charge just for excess inventory and purchase commitments related to H20.
Precisely. That single charge, $4.5 billion, is bigger than the quarterly revenue of a lot of major tech companies. It's a stark measure of the immediate financial cost of these regulatory changes.
Unbelievable. So what happened with that H20 inventory in Q2 then? You said sales to China were zero?
Zero to China, correct. But here's a little twist. They managed to sell $650 million worth of H20 to a different customer, someone outside the restricted zone.
Ah, okay. So they offloaded some of it.
Right. And because of that sale, they could actually release $180 million of that previous $4.5 billion provision. It's like getting a small refund on the charge they took.
Okay, so a small positive swing there, but it highlights how complex this inventory management must be under these rules.
Absolutely. And the situation keeps evolving. The filing mentions that in August, so just after Q2 ended, the U.S. government did grant licenses for some H20 sales back into China.
Oh, interesting. So sales could resume?
Potentially. But the 10Q is clear. No revenue or shipments under those new licenses had happened yet as of the filing date. And there's another wrinkle.
What's that?
The USG has apparently expressed an expectation, their word, that they'll receive 15% of the revenue from any sales made under these new H20 licenses.
Wait, the government expects a 15% cut of the sales, like a tax or royalty.
Kind of. The company notes this isn't actually codified in regulation yet. It's just an expectation. But if that becomes reality,
it fundamentally changes the profitability of selling those chips into China, even with a license.
yeah, the uncertainty isn't just if you can sell, but what the cost structure imposed by policy will be. It's incredibly complex.
And this isn't the only regulatory cloud hanging over them, is it?
Yeah.
There was that other rule mentioned earlier this year, the AI diffusion, IFR.
Right, the interim final rule from January 2025, that one looked really severe. It proposed worldwide licensing for basically all their cutting-edge stuff, H200, GB200, GB300.
So potentially restricting sales not just to China, but everywhere.
That was the concern. It could have been a major break on their global rollout. But good news for them, I suppose. In May 2025, the USG said they'd scrap that specific IFR.
Okay, so that threat is gone.
Well, yes and no. They're rescinding the January IFR, but they also said they'll implement a replacement rule instead.
And the scope of that replacement
Is unknown, totally uncertain right now. So the regulatory risk hasn't disappeared, it's just shifted form.
Yeah.
That lingering uncertainty can absolutely impact customer decisions, supply chains, everything.
So dealing with geopolitical whiplash, managing massive inventory provisions, navigating unclear future regulations, and all while trying to execute this huge Blackwell transition.
Exactly, which requires enormous forward planning and crucially massive capital commitment.
Let's look at those commitments. What kind of scale are we talking about?
Huge numbers again. As of the end of Q2, their total future commitments added up to $45.774 billion.
$45 billion. What's that mostly for?
It's mainly locking in future supply. So purchasing components like wafers and memory, agreements for manufacturing capacity, and also multi-year deals for cloud services they use themselves.
Okay, locking in supply makes sense given the demand. But how much of that is hitting soon?
That's the eye-popping part. Of that nearly $46 billion total, almost $30.93 billion is due within the rest of this fiscal year, so basically in the next 6 months.
$31 billion needed in cash outflow in the next 2 quarters. Is that at confidence or desperation to secure the supply chain?
Probably a bit of both. But you have to frame it as confidence. They're betting huge that the Blackwell demand will be there, and they're paying whatever it takes, locking in capacity now to stay ahead of any potential competitors.
And that preemptive spending must show up in their operating expenses too.
Absolutely. Total OPEX jumped 38% year over year in Q2. And R&D specifically was up 39%.
Where's that R&D money going?
Two big areas highlighted. Their own internal compute and infrastructure costs were up 68%. And engineering development for new products, think next-gen designs beyond Blackwell, also up 68%.
68% jumps in CapEx and engineering. They're just pouring money into staying ahead.
They have to. It's the cost of maintaining that leadership position in such a fast-moving field.
Okay, so they're spending massively, committing tens of billions, but they're also making massive amounts of money. What does their cash position look like?
Like a fortress. As of July 27th, they had $56.791 billion in cash equivalents, and marketable securities on hand.
$57 billion in the bank.
Pretty much. And look at cash flow. In the first half of this fiscal year alone, their operations generated nearly $43 billion in cash. $42.779 billion. They are an absolute cash machine.
And what are they doing with all that cash beside the massive R&D and commitments?
Oh.
Shareholder return.
Oh, yeah. Very aggressive shareholder returns. They bought back $24.2 billion worth of their own stock in just the first 6 months of the year.
$24 billion in buybacks already this year. How many shares was that?
About 193 million shares. But the really big news on this front came just after the quarter ended.
What happened then?
On August 26th, the board approved an additional $60 billion for share repurchases.
Another $60 billion, on top of whatever was left.
Exactly. Bringing the total amount they are authorized to spend on buybacks with no expiration date up to $71.2 billion.
$71 billion authorized for buybacks. That's more than the market cap of many large companies. That's a strategic weapon in itself.
It absolutely is. It signals huge confidence from management, maybe a sign they don't see any giant acquisitions they want to make right now. And it certainly provides a massive cushion or tool to manage their stock price and returns.
Any other balance sheet notes? Debt. Taxes.
Debt is pretty manageable. Net long-term debt around $8.5 billion. And they mentioned the OBBA, the One Big Beautiful Bill Act, some tax legislation from July, but said it didn't have a material impact on these Q2 numbers. The story is really cash generation and deployment.
Okay, let's try to wrap this all up for you, the listener. What we've seen in NVIDIA's Q2 is just incredible AI-driven growth. Nearly $47 billion revenue, soaring profits, fueled by this shift to selling entire data center systems.
But yeah, running alongside that incredible growth is this equally incredible volatility. You've got the regulatory risks, the China situation, the massive H20 inventory charge showing the real dollar cost of that.
So the core tension seems to be this balancing act. They're committing huge sums, nearly $46 billion in future commitments, spending massively on R&D to accelerate Blackwell and beyond.
Right. But they're balancing that against immense liquidity, almost $57 billion in cash, and now this enormous $71 billion buyback authorization waiting in the wings. It's like a super high-stakes, heavily capitalized operation designed to power through choppy waters and just overwhelm competitors with financial might.
Which leads us to a final thought for you to consider. With $71.2 billion available for share repurchases, that sheer amount of financial firepower, what kind of future shock could they be bracing for? Is it regulatory?
Yeah.
Geopolitical? Maybe a competitive threat? And how does having that kind of capital ready to deploy fundamentally alter the playing field in the AI race?
Something to think about. It's a fascinating picture.
Indeed. Thanks for diving deep with us today.